Through October 10th, or permanently because of bank greed and stupidity, the Federal Reserve pawnshop has Repo Madness. Up to $75 billion per day. Repo Madness. 14-day terms. Repo Madness. Free pickup of your toxic assets in a hazmat or radiation suit. Repo Madness. We'll buy any toxic sausage. We'll overpay. We'll pay full price. We'll buy it back. Guaranteed.
So, hopefully you liked my additional Repo Madness commercial in the cheesy used car salesman pawn shop voice. Again, the Repo Madness continues. Apparently, people liked my Repo Madness phrase so much that Real Vision TV now has their newest video labeled and their marketing material on their Twitter labeled Repo Madness. I was the first person to use that over a week ago. Repo Madness. So just more craziness in the repo market. Zero Hedge out with another article today, and the article is called Dollar Funding Shortage Accelerates as Both Overnight and Term Repo Oversubscribed. And they've been updating this a number of times today, so let me just hit the reload button and see if they updated it again. So it's been updated a number of times today. Yesterday's $75 billion overnight repo received only $65.7 billion worth of submissions. However, today seemed to be worse than normal. So it's supposed to be up to $75 billion per day in repo plus the 14-day term repo loans. So there's a combination of that, and I think the 14-day ones are around $30 billion. I have an article about that from Business Insider, the regular one, if you want to read it. Yeah, the $30 billion operation for the 14-day one. But today, apparently the funding shortage was more acute, and it actually got worse. So there were people saying it wouldn't get worse, and today, adding across the overnight and term repo operations, according to Zero Hedge, there was a total of $142 billion today alone, the highest yet. Interesting stuff, guys. Craziness. Repo Madness. So, in good times, I'm going to make sure you guys understand this. The repo system, overnight borrowing, the repo rates, repo over in good times, it is a normal part of the banking system. So, in good times, a bank will post U.S. Treasuries as collateral, which is considered good collateral. I know a lot of people in the gold community won't think it that way. But in good times, the Treasuries will be posted as collateral, and then the banks can borrow overnight at a specified borrowing rate and then have to pay back the money immediately. However, in bad times, and there's charts out there showing the history of the repo market going back through the year 2000, especially from 2000 to 2008. In bad times, you get scenarios where the repo market can spike up. It can go up fourfold in size borrowing. So in good times, the size of the repo market will be below $100 billion per day. Per month. So $100 billion per month in good times when banks are stable and things are not as bad. So there's not as many loans going as bad. There's not as many problems in the European banking system. There's not problems with collateralized loan obligations. And there was a new report out in the last couple weeks, actually this week, I think, because Bloomberg ran a story on it. And the report, initially there was a Bloomberg article, and I went for the actual source material because they're quoting a free report, which you can look at in the Bank of International Settlements from September 2019, and going through all the problems now that are happening with, and I've been talking about this for a couple months now, guys, collateralized loan obligations, Wall Street's next doomsday derivatives machine, and how the banks may be indirectly involved as counterparty risk when a lot of people thought that they wouldn't be. So there's an entire large section of this report in the Bank of International Settlements report for free. I can read it later in the article. So the question is, and this is why do we even need this much extra repo programs added by the Fed when the large U.S. banks supposedly have $1.4 trillion in reserves? So if the banks have that, the large U.S. banks have it docked at the Fed, $1.4 trillion in reserves, why are they not lending out the money? Because it's only overnight, right? If the repo market's functioning normally and times are supposedly good, and the U.S. economy is supposedly good and not in a recession, and there's supposedly not as many problems, then why are those $1.4 trillion in reserves not being lent out overnight? So, which means that the banks, in easier to understand terms, if the banks are not lending out that type of money, the banks no longer trust the other banks. So this gets into the Zero Hedge article more. I think the Zero Hedge article is suggesting that it's not American banks that are doing a lot of the borrowing at the overnight repo. That a lot of it has to do with dollar-denominated debt from European banks and other foreign banks. And they're the ones doing it. I have another interesting article from a hedge fund bank analyst and institutional bank analyst, Christopher Whalen, and he's talking about nationalizing the federal funds market. So this is a very interesting article, and it talks about how there's liquidity shortages that have been increasing for months now, and there's even research papers by, let me see here, the Federal Reserve Bank of St. Louis, Jane Ihrig, David N. Dolfato, and Jane Ihrig of the Federal Reserve Bank of St. Louis. They wrote a research paper that you can read on why the Federal Reserve should create a standing repo facility. So what that means in English, easier to understand, is permanent open market operations, or POMO, and permanent repo, new emergency liquidity program for the Fed. So this article talks about there's a lot more abbreviations in there. This guy is an institutional credit analyst, institutional bank analyst, Christopher Whalen. I've had him on in the past on my show. Good analysis there. He has a difficult time, though, explaining a lot of the complicated banking terms in easier to understand terms. So the Fed has realized that there could be problems with this for months now. And people at the Fed are worried about liquidity problems. And Luke Roman on his Twitter today from Forest for the Trees, he was talking about how it's not American banks that are borrowing a lot of the repo. Yes, permanent repo, it's not guaranteed that permanent repo is a new status quo yet, but it's looking that way. Okay, I was criticized that I did not understand repo. Those were commercials I put at the beginning. I am well aware that in a normal, when times are not as bad for the banks, that repo is done overnight's routine. However, it's when repo spikes per month. So when the amount of repos per month go from 100 billion or less per month in repos that are paid back with interest, treasuries posted as good collateral, it's when the amount of repos goes up fourfold in a month. That's the red flag. The other red flags are when treasuries are not the collateral that's posted, when it's worse than treasuries, when it's the toxic stuff, when it's the collateralized loan obligations, or in 2008, it was the mortgage-backed securities, or some of the Fannie and Freddie debt, the spikes in that. There's charts on this in the Wall Street for Main Street Facebook group from investment banks showing the spike in repo collateral that was based off of Fannie and Freddie debt and based off of besides U.S. Treasuries. So we'll see what happens. Everyone is warning, whether it's Danielle DiMartino Booth or others, that this is not officially QE until the 14-day term repos go past 14 days and the people find out whether the Fed announces it or not, God knows. And this is why we need, God only knows, this is why we need transparency. And I don't think we're going to get it, unfortunately. But this is why we should have independent audits. So the Fed, we find out that the Fed was paying full price, 100 cents on the dollar, or overpaying, maybe even over 100 cents on the dollar, back in 2007 and 8, for all those toxic mortgage-backed securities, all those collateralized debt obligations, all those collateralized mortgage obligations. They were overpaying. Stuff that might not have even been worth 10 cents on the dollar, the Fed was paying the banks full price for it to try to save the banks. And it still didn't work, and that's why the Fed in 2008 that's why the banks had to go and threaten Congress to get TARP, the Troubled Asset Relief Program, and then the Fed also had to start QE. So I don't know if we're there yet, but it's not looking good that the amounts are increasing. And the amounts, we were told at the end of last week and yesterday that the amounts on the repos were going down. And then today we had a spike. Okay, they assured us that things were calm, just like the Saudis assured us that their oil production would be back within weeks. And then I just found out, a couple days ago, that, oh, by the way, it's going to be another 8 months. I should make a funny commercial with the Saudis, like, he said, she said, Saudi said. I should make a goofy little skit about that. He said, she said, Saudi said. Gus says you can't keep a fake ship afloat. Well, eventually something will break, and then it will set off a chain reaction. What collapses first is we can only make educated guesses. Beard Axe Mick Axe Beard. Is it good they're using QE? So first of all, it's not officially QE. And they've also done rate cuts before an official recession, which is rare again. So we've had 2 rate cuts now before an official recession. Tomcat says, quick, let's create a toxic asset and sell it to the Fed at 10 times its pretend price. Oh, I wish. That would be a good business model. But unfortunately, only hedge funds and large banks are allowed to do that. But my educated guess of who was borrowing these repos are probably European banks with American subsidiaries, or the rumor on Chinese social media, like I reported last week, is that Chinese banks may have figured out a way to get access to the dollars, because China has a dollar shortage and emerging markets have a dollar shortage, and European banks may have bad loans in the Eurodollar market. Look, European banks have so many derivatives problems and bad loans. European banks have bad loans to emerging markets. European banks may be on the other side. The HSBC Bank and Deutsche Bank may be on the other side of those derivatives trades. They probably are. That the People's Bank of China and Chinese government has ordered the Chinese banks to do to backstop their currency because they didn't want to blow through all their reserves, selling massive amounts of forward dollar swaps. My friend David Jansen says that their derivatives position of selling massive amounts of forward dollar swaps is at least $1 trillion. I have not been able to get an official quote from Kyle Bass on what he thinks that number is. And I've not seen in any public interviews what he thinks that exact number is yet. And then there's people that are saying that this could be related to oil derivatives, that this could be there could have been a bad short trade in oil derivatives with the Saudi news, and that's what's causing the liquidity problems. Just more craziness. There's a interesting article here from Robert Wenzel on Saturday about the absurd fear-mongering begins. One or more big financial companies have run out of cash to pay bills they owe. So the rumor going around with repos was that there was a shortage of cash because corporations were paying taxes and they had to borrow money from banks to pay their taxes, and that's why there was a shortage. But I don't buy that. I think that was BS. So that was just a really short-term thing, and it was no big deal. I don't buy it. There's another article from Zero Hedge. These are the banks where the Fed's $1.4 trillion in reserves are parked. There are a lot of people that want the interest on excess reserves, a lot. Whether it's Judy Shelton or many other people, they want them removed entirely. And that was a large source of profits for the interest on excess reserves that were being paid out by the Fed to the large banks that kept their cash at the reserves. Not just the U.S. large banks, but also European banks too. So European banks with American subsidiaries had cash parked here. So the Fed was paying subsidies through the American taxpayer and devalued purchasing power to European banks too. And still European banks have all those problems. I'm not answering gold stock questions right now, but thank you in the chat section. I'll take a look later. I just want to talk about this repo madness stuff because clearly it's not over yet. Cody asked, could you beat Jerome Powell in a fight? Would I? No, I'd like to see Bill Holter fight Jerome Powell. Are repo rates skyrocketing? Let me see if it says it in the article. I don't remember reading that the repo rates themselves skyrocketed, but it's more disturbed. No, so the repo rates themselves are not skyrocketing yet. What's more disturbing is that the amounts are oversubscribed. So there's an oversubscription on the 75 billion per day, the extra one, and then the oversubscription on the 30 billion 14-term ones. So it's not that the overnight repo rate spiked, it's that there's an oversubscription. There's a lot of demand for these emergency liquidity programs. That's the red flag. My opinion on how long this staves off collapse in markets. Well, it depends which market. I think the Federal Reserve will probably try to keep things together through one emergency liquidity program or QE through the 2020 election, but we'll see. But something is going to collapse. I don't know if it's the corporate bond market in the US. There's a lot of red flags there. That's an enormous economic landmine. Emerging markets are an enormous economic landmine. Given the strength of the dollar, go look at the US trade-weighted dollar index on the St. Louis Fed website. It's still high. I think it's a little over 130. So it's not at an all-time high, but it is close to it. So as long as the trade-weighted dollar index is strong, that is hurting emerging markets. Because emerging markets, I've talked about this on previous videos, there's about 4 or 5 very large factors that are hurting emerging markets really bad, and it's not just the strong, on a relative basis, the strong dollar. You have China slowing down, you have a bear market in a lot of commodities, especially base metals, and then you have debt problems within those economies themselves. So you have dollar-denominated debt, China slowing down, commodities, bear markets in a lot of commodities, the global economy slowing down, and then the debt within those emerging market countries as well. So there's a lot of factors that are hurting emerging markets right now. They would love to see, emerging markets would love to see a weaker dollar because they bet on a weaker dollar for years now. They borrowed a lot of dollar-denominated debt. And this is why a lot of people are theorizing about a Plaza Accord. So I can't remember if I mentioned this a few days ago over the weekend, but I talked about Bob Lighthizer. Yeah, I think I did mention this. So Bob Lighthizer is Trump's key guy. He's one of the few advisors in the Trump administration that has an enormous amount of power. And probably why the U.S. will not agree to a trade deal with China, because I don't think Lighthizer wants to compromise. And anyways, Lighthizer was involved with, go back and listen to the clip I played with Peter Zeihan. Lighthizer was involved with the Plaza Accord. And what was the Plaza Accord? You can look it up on Wikipedia. That's where emerging markets back then, in the, I think, mid-1990s, they got in trouble again with dollar-denominated debt. They had borrowed too much dollar debt, and the dollar was too strong. And they had to come to the U.S. and they had to renegotiate trade deals with the U.S. And in exchange, the U.S. devalued the dollar to save emerging markets from collapsing massively because of their dollar-denominated debt. So the U.S. agreed as a trade-off to devalue the dollar in exchange for preferential trade deals. Now, the trade deals do not benefit a lot of Americans, especially the average Joe or Jane on Main Street, because the dollar is being devalued. That means you're getting less purchasing power and your savings are worth less. So you're not able to buy as much stuff with your dollars. But it does benefit, those preferential trade deals does benefit the U.S. government, and it does benefit large corporations who are exporting a lot, normally to an emerging market in the trade deal. So if we do have another Plaza Accord and the dollar is massively devalued, it will not benefit most Americans. But I think we could be heading towards another scenario like that in the next couple years. Eric Townsend at Macro Voices has been talking about this for a while, that is a scenario. If the dollar does get too strong Macro Voices podcast is very good. So excellent free resource. I don't agree with everything the co-hosts or the guests say, but it is really good, especially for a free resource. And they have been theorizing that eventually this dollar rally will either stay at these levels or get strong. More money will come into the U.S. for flight capital, and then the dollar will need to be devalued because otherwise it will immediately collapse. Emerging market governments, emerging market banks, emerging market corporations, etc. Jack says a plaza accord with China is not going to happen. I agree. It might happen with other emerging markets though. A plaza accord with China would be giving in to China. That would be a trade agreement, a part of a trade deal probably, and I just don't see that. Actually, from what I've heard, Jack, that the Chinese believe that the worst case scenario for anything in the Chinese economy is Japan, so that they'll still have a functioning economy. They'll just have zombie banks and some zombie corporations, zombie state-owned enterprises. So the people running the economy and the government in China think worst case scenario is they go negative interest rates, they inject QE, they bail out all RMB debt, and worst case scenario is Japan. I would call that probably hubris or overconfidence. Very similar words. Alexander, the Trump impeachment's not going to happen because even if it gets through the House of Representatives, the Republicans still control too much of the Senate. So even if it gets through the House, the Senate won't do it. So it doesn't matter unless the Senate changes. But we have the 2020 presidential election before the Senate would change. So the way impeachment works is the House has to move the charges forward. They have to vote on the charges, and they may be able to move something through, but then it'll die in the Senate for sure. I think there's a very little chance. They'd have to flip a bunch of neocon Republicans, and Trump is giving them all enormous money for their military spending. Trump already has less power because the Democrats are bogging things down in Congress. So Trump has to do all these executive orders. Not that when Trump had a regular Republican Congress anyway, things were getting done because Paul Ryan, who is the Speaker of the House, was blocking everything. There was a lot of Republicans in the House of Representatives. The main one was Paul Ryan, from what I hear. He was blocking pretty much everything, from what I hear. John McCain in the Senate was blocking everything with Trump. And then Paul Ryan was blocking everything in the House. So Trump was able to get some stuff done, but John McCain blocked a lot of it, and Paul Ryan blocked even more. Oh, thank you, Tarkinas, for the super chat. I appreciate it. So this proposal here is this Christopher Whalen article. Let me read you some quotes here. Quote, even though balance sheet normalization is well underway, we think it is never too late to introduce a repo facility. This was written a couple months ago, this research report. The FOMC, Federal Open Market Committee, would learn over time whether the facility is working to reduce the demand for reserves. The FOMC could do so, for example, by permitting reserves to run off organically with the growth of currency in circulation, while remaining confident that interest rate control would be maintained through the repo facility. So the authors essentially argue that by making a market in Treasury and agency securities, at least Ginnie Mae and Federal Home Loan Bank issues via a standing repo facility, the FOMC can encourage banks to meet their reserve requirements by holding securities instead of reserves. They also suggest that a permanent repo facility would allow the FOMC to continue to shrink the system open market account portfolio, and they suggest another not insignificant benefit of encouraging banks to treat Treasury securities as equivalent to reserves. Quote, finally, apart from being consistent with the 2014 policy normalization principles and plans, a repo facility would minimize the politically bad optics of the Fed paying interest on reserves, of which a large share goes to foreign banks. It seems both wise and proper to let the Treasury directly bear the interest expense associated with the regulatory demand for high-quality liquid assets. So the question of how much monetary policy intrudes into private markets, including the fiscal operations of the Treasury, was raised by someone with the Twitter here, and there's a lot more complaints and arguing about this. So it seems that a lot of people inside the Fed want POMO, permanent open market operations. They want a permanent repo facility. They want another permanent emergency liquidity program that is technically not QE. And this is the problem with giving the banks all this free money in reserves, and then the banks deciding not to lend it. There is $1.4 trillion in reserves that the banks, the largest U.S. banks, supposedly have. Why are they not lending it? Interesting stuff. My educated guess on why they're not lending it? Because some collateralized loan obligations are starting to go bad. There was just a new article out about this, like I said earlier in the show, from Bloomberg, that now banks have enormous indirect exposure counterparty risk to CLOs going bad because of hedge funds. So let me read this box B here in this Bank of International Settlements quarterly report that's out about risk. So collateralized debt obligations, CDOs, that invested in subprime mortgage-backed securities, MBS, were at the center of the 2008 financial crisis or Great Financial Crisis. The issuance of subprime CDOs ceased after the financial crisis, but other forms of securitization have grown substantially. In particular, collateralized loan obligations. CLOs invest mainly in leveraged loans, i.e. bank loans to firms that are highly indebted, have high debt service costs relative to earnings, and are typically rated below investment grade. So if they're rated below investment grade, they're either near junk or junk. The leveraged loan market has surged in recent years to roughly 1.4 trillion outstanding, of which about 200 billion is denominated in euros and the rest in US dollars. This rapid expansion has been accompanied by the securitization of leveraged loans into CLOs. As of June 2019, over 50% of outstanding leveraged loans in US dollars and about 60% of those in euros have been securitized through collateralized loan obligations. The rapid growth of leveraged finance and CLOs has parallels with developments in the U.S. subprime mortgage market and CDOs during the run-up to the 2008 financial crisis. We examine the CLO market in light of that earlier experience. There are significant differences between the CLO market today and the CDO market prior to the 2008 financial crisis. CLOs are less complex, avoiding the use of credit default swaps and re-securitizations. So hypothecations, synthetic CDOs, just stuff. If you don't want to get into the weeds of this, you don't need to worry about it. The stuff that's in the collateralized loan obligations, if you're not familiar, I did a show on this, I want to say last month. So I labeled it Wall Street's Derivatives New Derivatives Doomsday Machine, CLO, collateralized loan obligations. And this is toxic sausage. These are really, really bad leverage loans that were sold to companies that are junk debt or lower, or even worse than junk debt. So what that means then is these companies, they didn't even, so normally if you're a publicly traded company, you have, in order to borrow money from public markets or a bank, you need debt covenants. So you have to have certain debt to cash flow ratios. You have to have certain debt to equity ratios. You have to have certain debt to free cash flow ratios if it's strict. If the debt covenant ratios are laxed, very lax now, which we have very lax ratios, they are debt to EBITDA, or as I prefer EBITDA. So debt to earnings before interest, taxes, depreciation, amortization, which is not really earnings at all. So it's extremely laxed because debt to free cash flow ratios, debt to equity ratios, debt to cash flow is a lot more strict. EBITDA is not strict at all, in my opinion. And I don't even look at EBITDA at all when I'm looking at a company and analyzing it for potential investment for research. And it's a red flag. So if you see a management team discuss on the conference call or analysts talk about EBITDA nonstop, EBITDA multiples, you see EBITDA mentioned in the investors' presentations, the PowerPoints, all over the place, nothing but EBITDA. They don't talk about free cash flow. They don't talk about how much cash flow they have, their margins, any of those things that are more strict, especially free cash flow and enormous cash flow growth, then red flags. If they're just discussing EBITDA in all their financial documents, annual reports, quarterly reports, investors' presentations on their website. Okay, back to this. Let's see here where I left off. Okay, CLOs are less complex, so CLOs are chopped up into pieces, very similar to mortgage-backed securities in that regard, chopped up into pieces, really bad leveraged loans and junk debt, corporate bond junk debt, or lower than junk. No, it's called covenant light or no covenant. And I have from a whistleblower, from a loyal podcast listener of the show, this person who works at one of the major ratings agencies sent me a copy of an internal report on how to rate this garbage as a higher rating, even if the debt is basically worthless or close to worthless. Shouldn't be rated at all. If the debt is worthless, still assigning a higher rating. That's how bad this stuff is. Okay, back to the article. Keep going on rants here. CLOs are less complex, avoiding the use of credit default swaps and re-securitizations. They are little used as collateral in repo transactions, and they are less, so they're not used as collateral. In good times, the CLOs will not be used as collateral. In the 2007-2008 scenario, they would be. So if things get worse, we could have CLOs where the Fed claims that the CLOs are good collateral for these overnight borrowing, and then the Fed is secretly buying them up like what they did with mortgage-backed securities in 2007, 2008, because I remember speaking to financial professionals back then, when the repos were happening back then, that they were only overnight short-term loans. That it was on good collateral, that the Fed would not own them permanently, that the banks would pay back the loans. And guess what? The loans were paid back until they weren't. And we may be setting up in the near future something similar. Okay, it's not happening yet. We have no evidence yet. But if the size of repos spike and these things are oversubscribed, then the Fed announces permanent repo operations, permanent open market operations, or permanent repo, then that would be a sign that they're going to start buying up this junk and not calling it QE. Okay, again, off on another tangent. And less commonly funded by short borrowing than this was the case for CDOs. In addition, there's better information about the direct exposure of banks. That said, there are also similarities between the CLO market today and the CDO market then, including some that could give rise to financial distress. These include the deteriorating credit quality of CLOs' underlying assets, the opacity of indirect exposures, the high concentration of banks' direct holdings, and the uncertain resilience of senior tranches. So the senior tranche stuff is very similar to mortgage-backed securities, when the more dangerous mortgage-backed securities that were subprime MBS mortgage-backed securities, those were higher yield and still received a high rubber stamp rating by the ratings agencies. The senior tranches were supposedly the prime mortgages, and those had AAA stamps on those too. And remember, the subprime mortgages infected the prime mortgages, and the prime mortgages also failed. So I'm not saying that this is going to happen again, but you never know. So, in the uncertain resilience of senior tranches, so apparently there's different ratings for the CLOs, where some of them are supposedly more secure, with better companies issuing junk bonds or covenant light stuff. Although from what I've read in the research reports about the CLOs, there is now, according to Fitch ratings earlier this year, the article was under that video that I talked about that I did last month. I put additional supplemental research that there was 80%, up to 80%, some of these CLOs have, of covenant light or worse inside them. Covenant light, corporate bond debt or worse. So the credit quality of CLO's underlying asset, the opacity of indirect exposure, the high concentration of banks' direct holdings, and the uncertain resilience of senior tranches, which depend crucially on the correlation of losses among underlying loans. So there's a table here in the report for the Bank of International Settlements that shows you guys the differences between the CDO of the past, the last financial crisis, and the CLO now. See, if you want to look at that later, I'll put a link to the reports for free if you want to read it. CDOs, if you don't want to read the Bloomberg article, which probably summarizes some of this, but we're going to the root source. CDOs and CLOs are asset-backed securities that invest in pools of illiquid assets and convert them into marketable securities. They are structured in tranches, which have different priorities in terms of the cash flows from the underlying assets. The most junior, or so-called equity tranche, is often unrated, and earns the highest yields, but is the first to absorb credit losses. Basically, it means it's going to zero if things get worse, just like the subprime mortgage-backed securities. The most senior tranche, which is often rated AAA, receives the lowest yields, but is the last to absorb losses. In between are mezzanine tranches, usually rated from BB to AA, which start to absorb credit losses once the equity tranche is wiped out. The larger the share of junior tranches in the capital structure of the pool, the more protected the senior tranche for a given level of portfolio credit risk. You know, this sounds very similar to how the mortgage-backed securities were, how people thought they had a buffer protecting them if they were in the prime. The higher quality mortgage-backed securities that were stamped AAA, because remember, they were just repeating that subprime is contained, subprime will not leak into prime. It was repeated ad nauseum by Ben Bernanke on TV and others in the mainstream media, mainstream financial media, and mainstream financial professionals on Wall Street. CLOs are backed by simpler, more diversified pools of collateral than CDOs. CDOs issued in the run-up to the 2008 financial crisis consisted mainly of subprime mortgage-backed securities, and CDOs backed by other CDOs, so-called CDO squared, the synthetic stuff, were common. In 2006, almost 70% of the collateral of newly issued CDOs corresponded to subprime mortgage-backed securities. Wow, 70% were subprime mortgage-backed securities in 2006, and a further 15 were backed by other CDOs. Furthermore, more than 40% of the collateral gathered by the... And there was a research report that came out that it was 5.7 trillion worth of derivatives that led to the 2008 financial crisis. So there was a bunch of other problems there with AIG and others, but there was 5.7 trillion approximately in derivatives. That's what the research report has said. Furthermore, more than 40% of the collateral gathered by the CDOs issued that year was not cash mortgage-backed securities, but credit default swaps written on securities. When conditions in the housing market turn, the complexity and opacity of CDOs amplify financial stress. In contrast, CLOs are much less complex. Their collateral is diversified across firms and sectors, and the known incidence of synthetic collateral or re-securitizations is minimal. So there is less trickiness there. However, I would say that this junk bond debt inside the CLO is massively overrated, a lot of it. From what I've gathered from looking at the internal documents that I received, and other research, this stuff is massively overrated, a lot of it. Senior CLO tranches currently appear to benefit from larger loss-absorbing cushions than existed for CDOs. Larger loss-absorbing cushions, those... prophetic words there. We'll see if that holds up. Let's just say I'm not optimistic. Equity, and in particular mezzanine tranches, make up larger shares of the capital structure of CLOs than they did for pre-crisis subprime. However, the actual protection afforded to senior tranches depends crucially on their sensitivity to default risk and, importantly, loss correlation risk. Okay, I don't like how that's sounding. That's sounding not good. Default risk and losses given default depend on the quality of their underlying assets. For both CDOs and CLOs, strong investor demand, and this is the demand because of central banks manipulating interest rates down and starving people of yield. And this is why there's demand for this CLO, collateralized loan obligation garbage, by pension funds, by U.S. insurance companies, and others, and hedge funds, because it offers a yield. And I think some of these guys, if they're hedge funds, they think it's greater fool. They think that they can make a yield, leverage up their holdings, so use leverage to hold this stuff, and then flip it to a fool at a profit. Okay, for example, U.S. Subprime mortgages without full documentation of borrower's income increased from about 28% in 2001 to more than 50% in 2006. So that is the ninja loans. No income, no job, no assets. Likewise, leveraged loans without maintenance covenants increased from 20% up. Here we go, guys. This is the bad stuff. Leveraged loans without maintenance covenants increased from 20% in 2012 to 80% in 2018. So Fitch did a report on this earlier this year that was cited in another article. In recent years, the share of low-rated leveraged loans in CLOs has nearly the lowest rated ones, or right below the lowest rated, in CLOs has nearly doubled to 18%, and the debt-to-earnings ratio of leveraged borrowers has risen steadily. Weak under and the earnings, who knows if the earnings are actually real, could be financial engineering. Weak underwriting standards reduce the likelihood of defaults in the short run, but increase, weak underwriting standards. So these are lax debt covenant ratios. Reduce the likelihood of defaults in the short run, but increase the potential credit losses when a default eventually occurs. For CDOs, losses were exacerbated by the sensitivity of structures to correlation risk. The underlying collateral was poorly diversified, disproportionately consisting of low-rated tranches of subprime mortgage-backed security. Such strong demand for low-rated mortgage-backed security led to a growing reliance on synthetic exposures through collateralized CDS, credit default swaps, and re-securitization through CDO-squared vehicles, as discussed above. As a result, large share of CDO payoffs were driven by relatively small outstanding supply of low-quality securities. When housing prices fell and defaults in subprime mortgages mounted, returns on CDO, mezzanine, and senior tranches proved to be more highly correlated with the losses on equity tranches than many investors had expected. Uncertainty about loss correlations is acute for CLOs, yet remains a risk. Given the relative simplicity of these vehicles and the long history of defaults of high-yield corporate debt, loss correlations for leveraged loans, and thus CLOs, can in principle be estimated with more confidence than subprime mortgages. However, the unusually high share of deals with low investor protection could materially affect the timing and clustering of defaults, comprising the reliability of these estimation. Okay, here's the good part: banks exposure. This is mentioned in the Bloomberg article. We got to it. When CDOs experienced losses, the eventual distress was worsened by opacity about banks' total exposure. Pre-crisis, banks retained mostly senior exposures, either directly or through structured investment vehicles. Off-balance sheet entities where banks collected exposure to the CDOs and other securitized products. Sometimes, as investor demand for CDO mezzanine tranches swelled, banks ended up holding the senior tranches for which there was less demand. In other cases, banks became exposed to subprime BBB risk as they warehoused the securities while the portfolio of mortgage-backed security tranches were gathered by CDO managers. The structured investment vehicles are off-balance sheet stuff purportedly separate from their sponsoring banks, engaged in maturity transformation by funding themselves mainly in the short-term wholesale markets, making themselves susceptible to liquidity runs. Banks' indirect exposure through structured investment vehicles was underestimated by investors at the time, and banks' total exposure to CDOs before the 2008 financial crisis was hard to gauge accurately. Actually, the mainstream people didn't understand, but the gold community and the alternative media was warning people about the derivatives attached to the housing crisis, about housing prices. So there were warnings about the derivatives, but the mainstream financial media and a lot of financial professional mainstream ones didn't want to hear it or ignored it or laughed at it. Currently, banks' exposure to CLOs is less opaque. Banks still hold mostly AAA tranches, but these are recognized on their balance sheets, and there is no indirect exposure through structured investment vehicles. That said, banks may have other indirect exposures. Moreover, among banks, the concentration of CLO holdings is high. Wow, the banks have a lot of CLOs now. So U.S. and Japanese banks are among the largest investors in CLOs. Relatively few institutions account for the majority of banks' holdings, and in some cases, holdings are large relative to capital. Wow. So there's one more section here I'll read. Spillover risks. Non-bank investors such as hedge funds and insurance companies are also major investors in CLOs, as they were in collateralized debt obligations before the 2008 financial crisis. Ownership is more difficult to trace for non-bank investors than for banks. If non-bank investors were to experience losses on their CLO holdings, banks might be indirectly exposed. Let me get a sip of water. In particular, banks might be connected to those investors through legal and reputational ties, credit facilities, or prime brokerage services. Synthetic prime brokerage, where hedge funds obtain leverage through derivatives with banks as counterparties, has grown rapidly in recent years. It also entails lower regulatory capital charges, like banks' off-balance sheet exposure to CDOs, which was a source of instability in 2007. Banks' prime brokerage exposure to CLO holders could result in larger losses than implied by direct exposures, creating heightened financial stress. Additional spillovers could arise from disruptions in market liquidity. Since the global 2008 financial crisis, assets managed by fixed income mutual funds, including bank loan funds, have increased substantially. Investment funds offering daily redemption of shares hold as much as 3% of their assets in CLOs. At times of market distress, investors may, and it depends what additional leverage they're using to buy the CLOs. So if they're a hedge fund, they could have levered up 5x or 10x to buy these CLOs to increase their returns on a quarterly basis. Investment funds offering, and then if the trade goes against them, then the hedge funds are hurt. Investment funds offering, and if whoever offered the margin, normally a large bank offered them the margin, then the banks, if the hedge funds could not pay, the Fed might have to step in, depending upon how large the hedge fund is, similar to long-term capital management. Investment funds offering daily redemption of shares hold as much as 3% of their daily assets in CLOs. At times of market distress, investors may rush to redeem their shares, quickly depleting the liquidity buffers held by such funds. I don't think there's a lot of liquidity in general in these CLOs to buy and sell these things. This rush could result in fire sales and large price volatility, imposing mark-to-market losses on other intermediaries. And the banks, guys, the banks do not do well with mark-to-market losses. In fact, the banks are not even using mark-to-market accounting. They're still not using mark-to-market accounting. The banks are still not using mark-to-market accounting. The banks are using mark-to-model accounting. March 2009, FASB changed the rules. Besides the Fed putting in QE, the banks getting the accounting change. So yes, mark-to-market accounting hurts the banks bad. They don't want it anymore. If they had to do it, they'd probably already be bankrupt again and be insolvent. No, the Fed has not officially bought any of these yet. Okay, let me finish the article and then I'll look at listener questions and comments. I had a long phone call before this with someone who wants to help marketing my channel and grow my Patreon account contributors from almost 150 to more than that. So thank you, Brian, for the call. Thank you for your time. Much appreciated. But my voice is starting to go. So let me finish reading the article here. Okay, the banks do not want mark-to-market losses is kryptonite for the banks because the banks can't, at this point, they can't do it. European banks, American banks, Chinese banks, Japanese banks can't do mark-to-market losses. Price volatility could also disrupt short-term funding collateralized by CLOs, similarly to the run on repo in 2007. And the run on repo is when the banks were unable to pay back their overnight loans and why the Fed had to step in. Why the Congress TARP had to put TARP in, and then the Fed had to step in with QE. However, the use of CLOs as repo collateral appears minimal today, so that's good. That CLOs are not being used as collateral yet, thank God. In contrast to the more widespread use of collateralized debt obligations or mortgage-backed securities in the past. Okay, so we got some super chats here. Wow, quite a bit of them came in. Lonnie, thank you for the super chat. Sega Bear, thank you for the super chat. Tomcat, thank you for the super chat. And Dan, thank you for the super chat. Glad you like my research, Dan. Much appreciated. So there's a 6-minute interview on, if you're a Real Vision TV subscriber, there was a 6-minute interview that Danielle DiMartino Booth interviewed, let's see the guy's name, George Goncalves. Goncalves of the Bond Strategist. So it's only 6 minutes. It was released yesterday, and they decided they liked my marketing terms instead of Repocalypse, which Zero Hedge was using. I started this first and used Repo Madness last week. So Real Vision, I guess I should be flattered that Real Vision TV decided to use Repo Madness on their marketing now. So that interview is behind a paywall for now with Danielle DiMartino Booth and George Goncalves talking about former Fed insiders on dollar repo madness, going into detail about regulation and bank reserves and things like that are involved with this, and why the Fed may have to go to a permanent repo. Trademark Repo Madness. I think Repo Madness is better than Repocalypse. In the short term, gold could go down. This is just my opinion, not financial advice. In the short term, gold could go down. Probably by the end of the year, it will be higher. I'm still predicting, not financial advice, just my opinion. Gold is at least 1,600, maybe even 1,650 by the end of 2019. The U.S. still has to raise a lot more treasuries. There's a lot more treasury borrowing coming. There are a lot of problems with emerging markets with dollar-denominated debt with a strong dollar. There's a lot of problems with European banks. And there's a lot of problems in China. And if I'm right about the derivatives with the China selling forward dollar swaps, the other side of that trade, the other counterparty to those derivatives positions may be European banks, like Deutsche Bank and HSBC Bank, and they're probably not too happy about that now. Okay, so there's a couple other articles here if you want to go in depth about, from Zero Hedge a couple days ago on Sunday, about why the why the banks are refusing to lend out the 1.4 trillion in reserves, why they're parked there. Because look, there are a lot of reserves. There's plenty of money that could be lent. The question is, why are those 1.4 trillion in reserves not being used in the repo market? Because they should be able to be lent out overnight, and then they should get them back the next day with interest. And why are the banks deciding not to do that? Okay, I'm looking through listener questions and comments, but I think I'm going to shut this show down early. Well, in a couple minutes. It's been running almost 55 minutes. I had a long phone call before this. My voice is starting to go. Guys, it sounds like all the gold and silver stocks have been hammered today. I was going to do a gold and silver stock update because the Denver Gold Forum was last week, and I have some interesting insights from there. I was going to do a short video about this. I'm not sure if I can do it tonight because I'm pretty tired and my voice is starting to go. So maybe I'll do it tomorrow. I'll do an update. There's some interesting things out of the Denver Gold Forum. Okay, well, yeah, I'm too tired, man. Sorry, everyone. I'm too tired to do more. Okay, well, I'm shutting it down. Thank you for your time. And if you want to go more in depth on this, I'm going to attach all the sources there in the information and description section. So Repo Madness continues. We'll see if it goes past October 10th. It's looking like it probably will go past October 10th, but we'll see. But there are people, and there's going to be a couple people that are saying this is not true. I have links to the articles, links to the research reports from the Federal Reserve that want permanent open market operations and a permanent repo facility. There is a research paper out on this. It's from the St. Louis Fed a number of months ago. So the Fed has been wanting a permanent repo facility for a while. Okay, everyone, thank you for your time.